Today I'd like to talk about volatility. It's been over 3 years since we've had a 10% correction in the stock market, but investors still remember losing almost 40% in the Great Recession of 2008-2009. What comes with investing in stocks is volatility. Stocks go up, but you can be guaranteed that stocks go down. And if you're invested, whether it be 100% in stocks, 80, 60, 40, 30% in stocks, whatever your portfolio's mix of stocks and bonds are, you will have days, weeks, months, and sometimes years like 2008 where you lose money. But long term, stocks have been the best performing asset class. So investors shouldn't get caught up in the headlines, the day-to-day noise that you read or hear about. When you look long term, stock markets have done well. As you look at this chart, there's always a roller coaster ride in stocks. If you go back to 1997 through the year 2000, there was a 106% rise in the stock market. And then all of a sudden the stock market lost 49% of its value from 2000 through 2003. And then there was another bull market, a rally of 101% that ended in October of 2007. And then all of a sudden there was a correction of 57% that ended in 2009, March of 2009. And now since then the market has tripled, up 204%. Where this rally will end, we're not sure. But the roller coaster ride comes with the territory of investing in the stock market. In long term, that's what you have to keep in mind when you look at your investments. And hopefully you have that right mix in your portfolio long term, whatever your goals and objectives are. Most people it's for retirement. And always remember, when you're looking at your portfolio, even if you plan on retiring soon, you don't plan on dying. You just plan on retiring. If you retire at age 65, there's a good chance you're going to live to you're in your late 80s, early 90s. That's a long time. So even then, you may want some stocks in the mix of your investment portfolio. Now, when you go back to the noise in the marketplace, every year, no matter how well the stock market does, there's intra-year volatility. And when you look at any given year where the stock market may be off its high, don't get caught up in wanting to sell out, because if you're a long-term investor, it could hurt you. Look at this chart. If you look just in the year 2013, the market was off 6%. 2012, the market was off 10%. 2011, the market was off 19%. And most recently, last year, the market was off 7% in October. So in any given year, the markets will have some volatility. But once again, long term is what you want to look at. So how should you look at your portfolio long term? And this may be my favorite chart. If you're invested in stocks, bonds, or a mix, in any one year, any given year, if you're invested in stocks, history has shown you could have made as much as 51% or lost as much as 37%, which was 2008. In bonds, you could have made as much as 43% or lost as much as 8% in any one given year. And with a 50-50 portfolio, 50% bonds, 50% stocks, you could have been up as much as 32%, down 15%. This will give you a good idea of that mix that should be right for you. How much risk are you willing to take? How much can you tolerate? But let's move on, looking at this chart. When you look at the 5, 10, and 20-year rolling averages, as you can see, if you were 100% invested in stocks and you were invested in the 5-year, rolling average, you're up as much as 28%, down only 2%. That's a whole lot different than the 1-year statistics that we just went over. When you look at 10 years, you could be up as much as 19%, down as much as 1%. And for 20 years, up 18%, or as little as being up 6%. The point I'm making, and this chart spells it out, is that long term, if you're invested in stocks, the chance of losing money becomes less, because with time, stocks have done well, which is why over time, stocks has been the best performing asset class. And when you blend in bonds and other alternative assets or cash, you can actually reduce some of the volatility. But the point is, don't be afraid when stocks go down, whether it be intra-year or for a whole year, because it comes with the territory of investing. Look long term. Make sure you're comfortable with the amount of risk you're taking. Sit down with your financial advisor. Have he or she explain how you're invested. Let them show you how well or not your portfolio has performed, and then you make the decision of what's right for you. I thank you for looking at our segment today. Please come back. We will have segments regularly that hopefully you will find informative.